The housing market is going into a tailspin. The administration is freaking out, and the builders are just going over a cliff right now, building the wrong product in the wrong market. Let's dig into how this can impact you and what to do if you're a seller in today's market or even a buyer. How do you navigate these fast changing times? So, everyone right now says that we have a housing shortage. That has been the narrative for quite a long time. But look at this chart. Housing units are authorized, but they're not being started. How can we have a shortage when we have all of these lots available, ready to go? They're basically permitted and they're all the way approved, and they're just not starting the construction on those houses. How could we really have this type of scenario go through? So this is Fred, newly privately owned housing units authorized, but not started total units. We're at this record high type of period that we're at. And I think this is going to change really, really quickly, but builders are struggling. Why is this happening? Why are builders struggling right now? They have this tons of inventory that's just ready to go to build. The reason why is because over the past few years, they've been building the wrong type of inventory. And all of this is not necessarily their fault. Of course, they're going to go after the most high margin product that they can possibly get. But just look at this. This is the total regulatory cost for a Florida single family home. Impact fees, 10 to 30,000, permits and reviews, 2K to 6K. This is just the government charging fees. Hurricane, and of course it goes to things that are really important. We want safe housing, absolutely. But these fees are really expensive for housing, especially for affordable housing. Hurricane code, 15 to 35K, flood elevation, delay in soft costs, right? So total cost just on these, and this is a conservative range, can be $30 to $80,000 per house. This does not even include the lot of the house. So why this kills starter homes? For a project to be $200 to $250,000 for a starter home, 40K in regulation is about 16 to 20% of the entire price of the house. And this does not scale down with this smaller home. So they're paying roughly about the same amount, whether they build a $400 or a $500,000 house, or if they're building a $250,000 house. So of course, builders are going to push up the market because the fees are a smaller percentage of the price. So they are more incentivized to build a $500,000, $700,000 house than they are a $200,000 to $250,000 house. Their margins basically double over this time period. So over this cost spread. Look at regulatory costs. Land costs have gone up. Selling costs are pretty expensive, right? When you have to buy the land, you pay a commission, you pay title, you pay closing fees. When you sell it, you do the same. Obviously, insurance, financing costs have gone up. Labor and material labor was absolutely insane over the last few years. Material costs as well, when you look at what happened with lumber. And so we had all of these costs just go and skyrocket. So the builders needed to build at higher price points to be able to get their margins that they usually get, which is about 18 to 22% of the home price of the house. So obviously you'd rather get 18 to 20%, 22% of a $700,000 house than a $250,000 house. And it's a lot of work regardless of which house you're building. So this is what we're talking about. They're building at this price point that's unattainable for the next generation of home buyers because the input costs and the labor costs, all of this is so expensive for them to build. So I'm not blaming builders at all, but I'm saying this is why we're seeing so many of the issues that we're seeing today with the next generation of home buyers. So look at this. New home inventory levels are hitting 2009 levels, right? So this is completed, under construction, and not started. They're just stacking up across the board because the next generation isn't able to afford these prices at these interest rates. And of course, how do builders respond? They need to bring the prices down to adjust for this. This is new home prices, net of incentives, are down 27% from the peak already. This is nearly a crash. A crash is 30% from the peak. Obviously, if you're in that buyer in 2022, that was the worst possible time to buy new construction in a lot of the areas around the Sun Belt. And this is a chart from Lennar and Reventure Consulting, who put out great pieces of data. Highly recommend Nick and his team for real estate data. But new construction is now actually lower of a cost than prices for existing homes because these input costs have gone. So the builders have built at price points that are just completely unattainable to the next generation. So here's the chart that shows this, and this is a really scary fact. So this is new versus existing houses, historical price comparison from 1999 to 2025. You can see that generally new homes are 15 to 20% above existing homes. And then we had this flip-flop here because the new home prices just went way too high with the cost of all the inputs, building in areas where people aren't as excited to live in. And this is causing a lot of unintended consequences in the marketplace. And now the existing homes are actually more expensive than new homes, and the builders are slashing their prices left and right to get out of their positions. And in some cases, they're selling their entire portfolio to a build to rent operator to get out of their position. So I'd love to hear from you. When you look at this chart, what does it make you think? Comment down below and let me know if you're looking for a real estate agent to buy a new home, no matter where you're at. Reach out to me. I'll get you in touch with somebody who actually knows how to negotiate. You would be surprised at how much builders will be willing to negotiate with you right now. I even talked a friend out of buying a new construction home here locally recently, and after he didn't buy, the price has already come down $50,000, more than 10%, and he would have been that sucker buying at the peak of the market. And all he had to do is just wait a little bit longer for the builder to capitulate on price. And of course, these high prices across the board, just existing homes and the new construction, it's just the share of first-time home buyers is just declining, right? It used to be 40% all the way up to 50%. It's dropped from 50% nearly down to 20% just over the last 2 decades. And so we need more first-time home buyers, not less. I feel bad for this next generation. They're completely locked out. They're loaded up with debt, and their shelter costs are just super high relative to their incomes. And this is why prices will have to come down, because you have to ask yourself, who is the next buyer who is going to buy all of these overpriced, outdated houses? Because buyers can barely buy the new construction, which obviously most people prefer new construction because nobody else has lived in the home. Everything's updated. There's not a lot of upkeep you have to do with them. However, the location is a problem in some circumstances, but overall, you're seeing the share of the first-time home buyers is declining. And this chart is absolutely terrifying. This is estimated percentage of 30-year-olds who are both married and homeowners. It has dropped from 50% in the 1950s all the way down to about 12% today. So this is because people aren't buying houses, obviously, and they're getting married later. This is because there's obviously dual income families now. The cost of having kids is too expensive. The cost of owning a home, right? Typically, you get married, you buy a house, and then you have a kid, or some version of that trajectory. And at this point, it's like very expensive to even get married. I mean, I see people throw very lavish weddings. Hopefully, it's up to you on what you think about that. I don't think it's necessary to throw a lavish wedding, especially if you're trying to save to buy your first house. But you're seeing the next generation be kind of reckless with their money. But they're also just frustrated because they're loaded up with so much debt. I kind of understand the conception there, but you're just kind of digging yourself more into a hole there. They're not getting married, and they can't afford to buy a house. So this is really bad long term for the housing market. Because if people aren't having kids, you have to imagine in 30 years, who is going to be the buyer of your house? If you're buying real estate for the long term, again, who is going to be that buyer of the house? If you see the birth rates really decline, people aren't getting married, and it's going to be a major problem. This and the demographic crisis of the silver tsunami will be the major talking points over the next decade or so. And now we're seeing the median age of all home buyers is now 59 years old, up from 31 in 1981. So people are just, these are generally people who bought 20 years ago, and now they're selling the house that they bought 20 years ago and then upsizing or downsizing their house, or making the move that they want. But ultimately, just shows you the next generation is priced out. Used to be buying at 30 years old. Now you might even be a first-time home buyer at 59. A lot of these people are repeat buyers, of course, but there's a lot of people in those generations, in the boomer generations, that were left behind too. It's not just the younger folks who are priced out of this marketplace. And look, it's getting worse. This is what happened after Trump's going after the Greenland acquisition and threatening tariffs. The EU's responding with counter tariffs. It's escalating very quickly. And obviously, one of the things that can happen is Europe can start selling off our treasury bonds in the marketplace, start selling off our mortgage-backed securities. And obviously, that's going to spike rates here. And so we saw that this morning on the 30-year and on the 10-year. We just saw rates spike. And so obviously, if we're seeing this type of fluctuation in mortgage rates, we're already at a very fragile market. A lot of people are hoping that mortgage rates come down and it'll keep pushing the housing market along. But if they go up and they keep going up, this is going to be a huge problem for the marketplace because we're going to have to see those prices come down a lot more for the next generation of buyers to come in and be able to purchase. Another indicator that the market's ready to basically crack open is household stock wealth is now higher than real estate wealth. This has only happened two times before, the late 60s and the 1990s, and both times there was a bear market that lasted for years. It's basically just an indicator, just keep this in the back of your mind, that financial assets are inflated, okay? That includes stocks. We see stocks selling off 2% today. And, that's just off to the tariff announcements. But I mean, when you're looking at valuations across the board from real estate or from the stock market portfolios, the numbers are kind of really high. So you need to be really careful in this market where you're going to put your financial capital because these prices could come down pretty quickly, especially in the stock market here. Now, what happens next is we're already starting to see it. You can see that we're just trending along the line right here, where we're about to see prices start go negative across the board in the United States, right? So a lot of the times you've heard the saying, real estate goes up 3 to 4% every single year. Not so fast, not last year, not this year, probably not next year either. Prices will have to start going negative nationwide to catch up with the lack of wage growth that we've had. So, and the fact that buyers just can't afford to buy because they're loaded up with debt, the delinquencies are starting to move up, and you start putting the narrative together and you can see that it's going to be a long trek for those bulls who are still calling. I know Housing Wire is still putting out stuff there that, we're about to go on like a 25-year bull run. Be very careful who you listen to. I mean, there's definitely some areas of the country that have a very short supply of inventory and a lot of people relocating here. I'm talking generally across the board, especially here in the Sun Belt. It's one of the worst times you could buy. I think 2022 will go down as the worst year ever to purchase a home. And then 23, 24 are also very tough years. 25 is a very tough year as well. But those are like the peak prices. And I think that we're going to start seeing a decline here, which is badly needed for the buyers. Okay. So we just had way too much of an acceleration in a short period of time. And it's time to come back to reality. Starting to see the foreclosures jump already. So Florida is leading the country. I know Tampa is, I think, the worst place for foreclosures. We had lots of new construction there, a lot of people moving out of the area after we had an influx. Prices just got too unsustainable. We're already starting to see the majority of foreclosures in stress show up in areas around new construction developments in Florida and Texas. With FHA specifically, we're starting to see people just default. They didn't have any money in their house. They bought it at the wrong time. The prices are down 50 to 100,000. They can't go to sell the house. They get stuck. We're getting calls for short sales and foreclosures every single day here through our real estate agents here at Momentum Realty. And it's a huge issue. If you're in trouble, reach out. We'd love to help and put you in touch with somebody who can help. Honestly, the best thing you can do is look at short sale. There's a lot of options that you could have, and we're happy to explore that with you. But this picture just shows the entire issue across the board. This is the 30-year mortgage payment for an average home, average price point, all that kind of stuff. It went from $1,600 all the way up to $3,000 within just a couple of years. $1,600 to $2,600 now, but we live in a payment economy. So when payments increase 62%, of course, that asset has to come down in value to bridge that gap if we're seeing mortgage rates move up. So this monthly payments are absolutely unsustainable. I don't know people in my generation, I'm 34 years old. I don't know people in my generation who are actually going to be able to make a $3,000 monthly payment and still pay all of their other bills. Definitely, if you have a dual income family, it becomes quite possible, but it's so tight that most people would rather rent for $1,500, $1,600, stay in a multifamily luxury apartment, or find just a smaller place to live, or live on the outskirts of town versus in the middle of the town. So, people are getting smart. They have options, and rents are coming down, and you can negotiate in a lot of circumstances. So this is ultimately what will describe the gap moving forward. This is why the housing market is frozen. Why would you buy a house when your payment, like we just talked about, $2,700 versus rent of $2,000? You can rent the same house for $2,000. So it used to be that you buy a house and it makes your housing expenses less, right? And you're saving a lot of money. It wasn't just something you could own and it would pay off in 30 years and it'd be a great retirement asset, which is fantastic. It used to be that you could own for nearly what you could rent. You could do the interest deduction, all that kind of stuff. Look at this green line. Like, it made sense to buy 2013 all the way up to 2019. And then we saw this massive explosion of home prices, and then we saw the rates move up. And that's really where the calculus and the math just made it way more makes sense to rent. And by the way, rents are coming down now, so we'll dig into that later as well. Is now a good time to buy? Just look at this chart and decide for yourself. First time home buyers, if I looked at this chart, I would be very terrified. I'd be extremely careful. And in a lot of cases, it is frankly better to rent than to buy. I know it's really hard to hear from somebody who runs a real estate company. However, it's just like the numbers are the numbers. Look at where prices are on a relative basis. Look at what's happened in the past. Look at all the new construction we're having. In some cases, it does make sense to buy, but you have to negotiate terms that are just absolutely phenomenal. Or it's got to be that one-off house that's like that house is not going to come up again, maybe for another decade or something like that. But if you're just generally like I'm just going to buy to buy, I've heard it's good to buy. Look at this chart and decide for yourself. And comment below. I'd love to hear from you. Does this chart look like something that you would like to buy in? And of course, that chart lines up perfectly with pending sales. The consumer is speaking. Obviously, they're not going to go out and buy a $500,000 house when they can't make the payment. So pending sales are down and they've dropped off a cliff since the Fed started raising rates in March of 2022. We're starting to see a little bit of a pickup, but it's just completely variable based on where we're seeing mortgage interest rates. When we see rates drop 20 basis points, boom, we see a little bit of a spike. And then when we see them go up, it just becomes a crawl. So real estate right now is really sensitive to what the interest rates are doing. And that's why we track that every single week. But ultimately, the consumer, I mean, they're having a really hard time. You can see this student loans delinquencies are up nearly 15%. Auto loan delinquencies are up. Credit card delinquencies are up. Everything is basically, and these loans are compounding. Their credit scores are getting hurt on their student loans. If you have a cosigner and they're not paying, that cosigner's credit's getting hurt. And all this is going to impact housing and the ability to get financing, or you're going to have to pay financing at a higher cost. So it's a huge issue. This comes from the New York Fed Consumer Credit Panel, and we are watching the delinquencies very closely. Because obviously some of these industries that are giving out these loans are going to have massive issues down the line. And of course, the government said that, hey, we're going to start pulling money out of people's paychecks to pay their delinquent student loans. They put that off because they don't want that pain ahead of the midterms in November. The government's going to try to keep everything propped up as much as humanly possible until midterms. After midterms, I can see the government not caring. But once, up until midterms, they need to keep the economy afloat until that time period. Because the number one way to get reelected, both parties know this, is you got to have a rocking economy. You got to make sure things are moving along. And unfortunately, that's not what we're seeing right now. This is the rents are already coming down, and this is a great thing for buyers and for renters. You got a lot of options here. Austin, Texas, already down 21%. In some cases, people on the ground there, I heard it's down 30%. You can see it's Texas, Florida, Colorado, Arizona, North Carolina. So a lot of these areas where we had these institutional buyers, they went up and bought in a lot of single family rentals. They jacked the prices. The builders went crazy and built. And now the institutional buyers stopped because the financing no longer makes sense. The cash flow no longer makes sense, and now they're overbuilt. And this is great for the next generation of buyers. We need a price correction. We need mean reversion so the next generation has a chance to buy in at reasonable prices and live their American dream. Right now, they're completely priced out, and it's going to take time for this correction to happen because, again, the government's going to step in and try to mitigate the consequences of this cycle that we're going through, which was basically caused by them. The Fed caused this in the first place because they brought interest rates down to zero. That induced a lot of people to go out there and buy a ton of real estate and jack up prices, and construction couldn't keep up with the demand, and then they overbuilt. So it's a pretty interesting thing to see. So I'd love to hear from you. How does this housing market actually resolve itself if prices don't come down? Is there any path possible where prices don't come down at all and actually keep going up? I'd love to hear from you. My prediction is that we're going to see a 31 to 42% decline from the peak in October of 2022. That's what my math model shows. And I'd love to hear from you. Where are you located? Where are you watching? What are you seeing on the ground? And what kind of videos are you looking forward to next? As always, you can follow me on Substack. My information is down below. I also have X profile at John Brooks. You can follow me there. I talk about a lot of things I can't talk about here on YouTube, and I'd love to hear from you more. Talk to you soon.